Welcome to NextGen Digital Finance, your go-to hub for mastering modern money management in the digital age. Whether you're looking to build wealth from scratch, crush debt and take control of your budget, explore fintech tools, crypto, side hustles, or investing apps, learn financial strategies tailored for Gen Z and millennials. This channel breaks down complex financial topics into clear, actionable insights, all designed for the next generation of earners, savers, and investors. Videos on digital budgeting, smart investing, side hustles, and money mindset. Honest reviews of financial apps, tools, and trends. Step-by-step guides to help you grow and manage your money confidently. Subscribe now and level up your financial future, one smart decision at a time. It's time to make your money work for you. Throughout the year 2025, gold has been constantly part of the financial news. It's one of the oldest forms of money the world has ever known, and yet in 2025, it's still part of some of the most modern investment portfolios. But why? Today, we're diving into gold, what makes it such a timeless asset, the best ways to invest in it right now, and what you absolutely need to consider before making it part of your wealth strategy. Stick around, because by the end of this video, you'll not only understand how to invest in gold, but also whether it makes sense for your unique goals. Quick disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and this is not financial advice. Always do your own research or speak with a licensed professional before making investment decisions. Why gold still matters in 2025. Gold isn't just a shiny rock. It's a financial tool. And in 2025, it's making a quiet but powerful comeback. Here's why. 1. Macroeconomic instability. We're still seeing high volatility from post-pandemic supply chains, global debt levels, energy markets, and AI-fueled tech disruptions. Gold acts as a buffer during uncertainty. When economies shake, gold often shines. 2. Inflation pressures. Despite aggressive rate hikes in 2023 to 2024, inflation remains sticky in many sectors, especially housing, healthcare, and food. Gold historically holds its value when fiat currencies lose purchasing power. 3. Psychological safety. Investors turn to gold when they don't trust the system, whether that's central banks, political leaders, or digital infrastructure. Financial emergency insurance. In short, gold isn't about explosive growth, it's about stability, a long-term hedge against the unpredictable. Top 5 gold investment options and U2D investment time. Now, let's break down the most common and effective ways to invest in gold, from traditional to tech-savvy. Number 1. Physical gold. Coins, bars, bullion. This is the OG method, literally holding gold in your hand. Pros. No counterparty risk, not dependent on banks or platforms. Universal value, accepted nearly anywhere on Earth. Cons. Needs secure storage, vaults, safes, or third-party services. Can be hard to liquidate quickly. Not practical for large investors. Watch for premiums over spot price. In 2025, average premiums are 3 to 6% for bullion bars, 6 to 12% for popular coins like American Eagles or Britannias. Tip: avoid collectibles unless you're a numismatist. Stick to investment-grade bullion. Number 2. Gold ETFs, exchange-traded funds. ETFs offer one of the simplest ways to get gold exposure without owning the physical asset. Popular picks: SPDR Gold Shares, GLD, holds over $50 billion in physical gold. iShares Gold Trust, IAU, similar exposure, but lower fees. Pros: super liquid, trade it like a stock. Low management fees, great for beginner investors. Cons: you don't actually own gold, you own shares in a fund. No direct redemption for physical metal. Expense ratios in 2025, IAU or 25%. Number 3. Gold mining stocks. Investing in companies that extract gold can give you leverage on gold prices. Example stocks: Newmont Corporation, NEM, Barrick Gold, GOLD, Agnico Eagle Mines, AEM. Pros: higher upside than gold itself if prices rise. Some pay dividends. Good exposure to broader metals sector. Cons: embarked higher risk, operations, labor, politics, and environmental issues. Stocks may drop even if gold rises, depending on company performance. Ideal for investors comfortable with equity risk. Number 4. gold mutual funds, and index funds. These funds invest in a basket of gold-related assets, including miners, refiners, and sometimes gold ETFs. Pros: instant diversification, managed by professionals, can retirement accounts. Cons: higher fees than ETFs, less control over holdings. Popular funds: VanEck Gold Miners ETF, GDX, Fidelity Select Gold Portfolio, 5, Digital Gold, via fintech platforms. Fintech platforms now offer fractional gold ownership backed by real bullion in secure vaults. Examples: Vaulted, gold stored in the Royal Canadian Mint. One Gold, backed by AppMex/Sprott, transparent and easy to use. Kinesis or Glint, gold plus mobile payments. Buy coffee with grams of gold. Pros: modern, convenient, and often fully audited. Great for smaller, younger investors. What to consider before buying. Let's talk strategy and risk management. Don't just buy gold because it sounds cool. Think it through. 1. Purpose of the investment. Is gold a hedge for you? A long-term store of value? An alternative to fiat? Clarify your goal before buying. 2. Storage and insurance. If you're going physical, know where and how it will be kept. Are you storing it at home, in a safety deposit box, or in a third-party vault? Example: in 2025, Brink's home vaults start at $150 a year for insured physical storage. 3. Costs and taxes. Physical gold has high premiums and selling spreads. ETFs and funds have fees that eat into returns. In the US, gold is taxed as a collectible, up to 28% on gains. If you're in a tax-advantaged account, like a Roth IRA, use gold ETFs, not physical metal, which can't be stored in those accounts directly. 4. Opportunity cost. Gold doesn't produce cash flow. No dividends, no interest. Holding too much gold could sound in any taxed and cash flow. No affordancy create all of these activisms are using TH. Travel daughter rolled on sounds 5 pages. Or establishment tax can provided state Irvis and things ready. The death is not Ben and yourself. Quickly, for program, compared to ANDA, continues with cospolation and mostly focused. It's tax on the grown. When you to do all the daughter by on long, is this year? Is tax on the equerry, the coverings from the verg. Gold anyone was wex, is this year? Easy proceed all the others of a verg. Example, in 2025, gold's considered before buying. Holding too much gold could slow down your portfolio's growth potential. 5 to 10% allocation is considered healthy. More than 15%? You better have a strong reason, like preparing for serious economic volatility. Is gold right for you in 2025? Ask yourself honestly, do you want to reduce exposure to stocks or crypto volatility? Do you see long-term risks in fiat currencies or geopolitical systems? Are you looking for a hard asset that has stood the test of time? If yes, gold can absolutely earn a place in your portfolio. But if you're looking to grow wealth aggressively, or if you're 100% focused on passive income, gold may not deliver what you're expecting. Think of it as a wealth protector. In the digital age, it's easy to overlook gold. But its value isn't in hype. It's in history, scarcity, and stability. Whether you're a crypto native, a stock picker, or just someone looking for peace of mind, gold might still have a golden role in your strategy. Tell me in the comments, are you currently investing in gold? If so, which method are you using? Like this video if you learned something new, hit subscribe and tap the bell for more insights. Follow us for more smart, modern money content right here on NextGen Digital Finance.